I see that our presenters are already logged in. They are about to present the topic determining the threshold for exchange rate instability in South Africa. And Simiso Msomi, I guess, will be making this presentation with Dr. Johnson Adelakun. So without much ado, Simiso, you have about 20 to 30 minutes to make your presentation. And then after that, we'll have a session of Q&A where we would expect participants to interrogate what you have shared with us. I think without wasting further time, you're free to take the floor, and please do introduce yourself so that we know you better as you go along. Thank you very much.
Morning, colleagues, and thank you for giving this opportunity to have this discussion. So I'm Dr. Simiso Msomi from the University of KwaZulu-Natal. I teach economics, macroeconomics in particular. I like to work on exchange rates. So most of my work is on exchange rates. So that's what I enjoy because I think there's so much we don't know from a policy perspective and in practice as well. And I think there's so many economic challenges that we can solve, like unemployment, poverty, and the rest, if we can be able to get to know this. So that's a brief story about myself. Yes, and I stay born and raised in Durban, KZN, South Africa. And I would also love maybe one day to come and deliver another talk in person at the university there, and perhaps maybe to have an opportunity to collaborate with other colleagues that side with the work that maybe they are doing. I don't know what more I can say about myself. I've never been asked to say something about myself. I hope that is okay. So with that being said, colleagues, so the topic is determining the threshold for exchange rate instability in South Africa. As I've indicated, that this presentation is organized for the seminar organized by the National University of Lesotho, which we are grateful for affording us this opportunity to have this scholarly discussion on this day. So the exchange rate behavior, as we know, remains one of the challenging concepts in macroeconomics literature. And hence, currencies sometimes face a possibility of crisis episodes because of an unusual exchange rate behavior, or because of the behavior that the exchange rates are always exhibiting. This has led to many researchers attempting to define what real exchange rates deviation can be considered as normal from equilibrium. So I will show later in subsequent slides how the exchange rates has been behaving since the 60s, but the situation is even far worse if you consider when South Africa started when South Africa exited the sterling area. So if you look at the whole picture, you see a long depreciation swing of the South African rand exchange rate, which adds to this question of what normal deviation from what can be considered as a normal deviation from equilibrium of the exchange rate. So, however, we've seen we've seen arbitrarily specified definitions of exchange rates depreciation in the literature. So some of the people we can look at, it's Rose, it's Frankel and Rose and Goldman and in 1997. Okay, I will make this point maybe in subsequent slides. So Alekans and Summers argue that this methodology imposes a uniform definition across countries to define an abnormal exchange rate movement. So the literature shows that the exchange rate behavior is determined differently in emerging market economies or in developing market economies, although we may find that in emerging economies or in developing economies, we may find that the markets are semi-developed and they function efficiently or close to what maybe is seen in the first world. However, there are those slight differences, which means that we have to take that into consideration when we make definitions or when we think about a normal deviation or a deviation that is considered normal for an exchange rate. So in this case, an arbitrary definition of the exchange rate instability might be unable to fit the conditions of the behavior of the exchange rates in emerging economies. Therefore, this is the picture that I spoke about. If you look at the exchange rates, the way it's been moving in South Africa since, so in this case, I just took from the 1980s, but you can see that when you take the snapshot, it's very concerning because this movement represents a constant depreciation. In some periods, yes, you find that there is excessive depreciation, and in other periods, there are some spikes. The spikes are small, but then if you look at the entire trend, it raises the question of what behavior of the exchange rate can still be considered as a normal deviation from equilibrium. So the sources of exchange rate instability are exogenous. What if Hale and Hugh in 2011 argued that the macroeconomic fundamental dynamics of the global capital markets and interest rates that are marginally high cause a continuous behavior of the exchange rate instability. So Mlambo and others also explain that the source of the rand exchange rate instability may be the financial flow, which makes achieving a stable exchange rate impossible. So now the South Africa adopted inflation targeting the adoption of inflation targeting by South African Reserve Bank contributes to sustaining a excessive depreciation because the exchange rate is prone to responding to global shocks because of the nature of the foreign exchange rates market. So when something happens, therefore, there will be a movement, or there will be something that occurs or there will be some response experienced in the exchange rates in the foreign exchange market. So it is extensively documented in the literature that the exchange rates sometimes undergo extreme behavioral changes. So further, the exchange rate behavior is also subject to unobserved factors, unobserved random factors. We can see Chuang and others, and Engel and West, they also discuss the same point. And this is also affirmed or is also quoted by Msomi and Galawa 2024, where they also say that the unknown factors lead to exchange rates transitioning into different states or into different states. In fact, Msomi and Galawa, they've produced two papers which also discuss this factor. So if we are interested, you can look at that because they go deeper into this subject. So in this situation, so the exchange rate behavior is inconsistent with any unexpected structural relationship. So hence the effect of unobserved factors cannot be obtained from the macroeconomic fundamentals, but their impact is observed on an exchange rate behavior. So now, in order to assess this, we use the threshold autoregressive model. The reason we choose the autoregressive model is because we want to establish, as the title shows, wants to establish whether there is a threshold whereby we can say the exchange rate, when it crosses this threshold, it goes on to being unstable, or when it remains there, therefore the exchange rate is stable, then we are unlikely to experience any maybe currency crisis or any event of that nature. So we use the threshold model because it will allow us to establish the threshold. So this one, it also helps us in identifying the switching variable. The switching variable, in this case, the switching variable is going to be the exchange rate itself. Now, the way we organize, or we set up the variable, or we define the threshold or the behavior of the variable of interest. So when you have the variable, so in this case, we're going to call it Z. Therefore, it means from one period when you have values that are behaving in a certain manner, therefore they would represent a different threshold. And if they behave in a way which is different from the previous manner, therefore they would be defining a different regime. So the model is estimated as an autoregressive model. Since it is a self-exciting model, we choose this because we want it to determine the model to determine the threshold itself. So now the thresholds can be more than one, which means you'll have more than two regimes. So it is possible, but it can also have just choose one regime depending on the data, because it's the definition of the threshold is decided by how the data behaves. Now, so this is how we're going to estimate the threshold autoregressive model. So the I is just an indicator function which goes back to this equation. So when the variables are in equation in behaving in a certain manner, let's say they are greater than rho, it means therefore they will represent a regime 1, and if they are less than rho, therefore they represent regime 2. So that's a simplified version. So then the rest is the same, because the variable is estimated, sorry, the threshold is estimated within the variable or the data that is provided. So the data is collected or we use the exchange rate only in order to determine the threshold. So because the aim is to let the exchange rate behavior define itself in terms of how it is moving and where it is directed. So now what we do, we apply the theory in its movement through the use of the threshold autoregressive model. So we collect the data from year 2000 to year 2001. And it is collected from the South African Reserve Bank. So as I said, the only variable we use is the real exchange rate. So then this now, because we said we're starting from year 2000 to year 2009, I just show how the exchange rate is, or take a snapshot between the period of interest. So this is the snapshot of the behavior of the exchange rates. So if you difference the exchange rates and try to see maybe how it's been evolving over the years, so this is the depiction of its behavior. Then what we did from here we smoothed out the behavior of the exchange rate so that we can see if there are any particular moments that are causing it to behave in this way. So what we see here is that even when we smooth it out, the exchange rate still behaves or still moves in the same fashion as it did. So which means it is not particularly influenced by some individual events that occur specifically in that period. So even if it is, but they only account for a small portion, as we can see as it is illustrated in this diagram. Then from here, we estimated a grid search. So the grid search results, it's a first process of trying to establish if there is a threshold in the model. So the aim here is to establish or is to determine if there is a U. If you look, but I will show you the diagram in the next slide. If you look at the variables, you'll see that they start from a higher number, then they decline, then they change. So that change and then they go up again. It shows that there is a threshold somewhere, or it shows that we have estimated the threshold correctly, in a sense that you can see that there is a change in values. So now it looks like this. So what I was trying to show you in numbers is shown in a diagram here. If you look at the diagram, it starts from, if you look at from the left-hand side, it starts from 4.2, then it goes down. If you look between 3.2 and 3.4, then it changes there, then it goes up. So it's a U. So this means that we have estimated the threshold correctly. Then so therefore we have to check whether the model is can be used in order to interpret or in order to make determinations about the behavior of the exchange rate. So the estimated threshold is 1.9, which means if the exchange rate moves above 1.9 percentage points, it means therefore that if it depreciates beyond that point, it means the exchange rate is headed to a crisis it's in a crisis regime. But below that point, the exchange rate, if it fluctuates below that point, it's still okay, but then it does not need to go far down beyond that point, because it will also head to a crisis situation. Now, if we look at the mean absolute percentage error, it's 1.225%, which means we have estimated good. We can use the model to interpret and maybe provide insights about the behavior of the exchange rates, because in statistics literature, they say that if the mean absolute percentage error is above 20%, therefore the model might not be stable. It has so many problems. Therefore, it means this one is estimated well and it can be used going forward. Now, then we estimated the model. So what you need here in this estimation is for the values to be different in different legs. So it means that therefore they have to fall from one to another to a subsequent leg. Therefore they have to keep declining. So which shows that the exchange rate responds differently in subsequent periods, which means it keeps changing. Therefore, this is what we observe here. And here we show the threshold as estimated. So because we programmed this when we were doing it, what we used when we program it, we used the trim of 15%. So now what we said is that at minimum, the exchange rate should not be defined for values that are less than 15%. So it means at each regime, you must at least have 15% of observations in order to make a determination. And this is quite a fair requirement, considering that if you look at other comparable studies, which I've seen one, which was done in year 2001 in Australia. So they used a trim of 5%. So which means this is way better in terms of providing information. So now in the second panel, it shows where the threshold is. So now this is where it's the epicenter of the study. What we see is that where there are black lines, it means we are in a different regime. The exchange rate is appreciating above 1.9, it's appreciating. Above that, it is depreciating. So now what we determined is that the exchange rate started off in an appreciating region. So in a region whereby we say the exchange rate is more stable, then it's depreciated and it crossed the threshold. But what is noticeable is that even though it crosses the threshold of and it gets into an instability threshold, so the exchange rate does not instantaneously become unstable, but then it remains stable. Then over period, as the period goes, then the exchange rate becomes more unstable, or it remains in a region or in a state of being in a crisis, or of high probability of being in a currency crisis. Then it goes back again. So what we see is that the information that was available previously, even if it crosses to another regime, it remains. But then over time, new information comes in, and then suddenly the behavior of the exchange rates behaves according to what is seen in that regime. But it does not change instantaneously, which means the transition to a different state is not instantaneous. So it takes time for the exchange rate to be to fully integrate into a position it is in. However, what we see from year 2010 onwards is that the exchange rate in South Africa has remained in a position of instability. And this means that there is a chance that a South African exchange rate might go into a crisis, into an exchange rate crisis, if there are problems, or if there is a shock that shocks the exchange rate, causes it to depreciate further on. So, okay, I say this with caution because there's a paper I cited earlier by Frankel and Rose, and there's also another one by Joseph Stiglitz in year 2000 and year 2001. So what they explain there is it is very difficult to comment about the behavior of an exchange rate in normal periods, but because the exchange rate responds to factors that are unobserved. However, if there is a major macroeconomic event, that's when it is easy to say where the direction the exchange rate will cause. So that's why we are saying the exchange rate currently is in a crisis, or is in a region of currency crisis, and therefore if there is a shock in the economy that would cause the exchange rate to further depreciate, the exchange rate would we would experience an exchange rate crisis in South Africa. So that is the conclusion. So in a nutshell, that is what I was doing. So then I made a controversial conclusion. So we all know that South Africa does not intervene in the foreign exchange market. So this is good. And sorry, I'm not saying this. We understand this position. However, the government or the central bank has an objective to protect the value of the rand. In an event whereby the exchange rate goes into a currency crisis or remains in that position, it means that the South Africa the rand is in a red zone per se. Therefore, the bank needs to stand ready with the resources like the reserves to defend the exchange rate in an event whereby the exchange rate gets in or continues on this trajectory, because once the shock occurs while we are in this state, it will be very difficult to recover from the effect will be too detrimental. Yes, it is a policy of the central bank that it does not intervene in the foreign exchange markets. However, this might be part of an exceptional cases whereby the central bank can uh, um, uh, say it is acting as part of or as part of mitigation in order to prevent a potential crisis if it might arise. That's where the discussion or the presentation ends. Thank you.
Thank you very much, Dr. Simiso, for that presentation. It has engaged us. It has aligned our thoughts this morning to the topic of exchange rate and how it behaves, especially for that of South Africa. So at this juncture, I'm going to open the floor for Q&A. I have a couple of questions or clarifications I need myself, but I would open the floor first, and we'll be taking the questions in a round of 3. So when we have the first 3 questions, Dr. Simiso and I guess Dr. Adilakun would have the floor to respond to them. Thank you. Can I see your hands? If I don't see your hand, please feel free to, okay, I see one hand. Dr. Ntokozo, please, you have the floor.
Thank you, Chair. Thanks, Dr. Msomi, for your insightful presentation. I have 1 or 2 questions, and the first one is on the equation 2. If you can quickly go to equation 2, I wasn't sure what exactly is the meaning of D. Is D greater than 1 or less than 1 in that equation? The
equation.
D.
Yes.
Yeah.
Okay. So the way we estimate it, you have a delayed lag in the estimation of the threshold autoregressive model. So which means you specify when you estimate it, how long do you want the response to be delayed by?
So what is the meaning of D? Is the delay, and how do you identify that delay? Let me just ask all the board questions that I had. Now, you're talking about 2 regimes. Can you give a meaning to those regimes? What exactly is the meaning of regime 1 and regime 2? And lastly, you say that you are using only the exchange rate. So now the question is, I'm just worried that your model may not pass what others will call the Sims critique, that everything depends on something else, because your model assumes that exchange rate only depends on itself, on the past values of itself. But according to Sims, that's not how the economy works. Everything else depends on something else. And also you're saying that your model, you're choosing a trim of 15%, and you're saying that it's better than the study that was done in Australia, which chose the 5%. Now, I wasn't sure on what basis are you saying that it's better. Is it just a mere speculation? Is it informed by anything? Where is it coming from? Thanks, Chair.
Thank you very much, Ntokozo, sorry. I am sure Dr. Simiso is taking notes while we take the other 2 hands. I saw Nadeta Mai and then Dr. Maketa in that order.
Thank you, Chair. Thank you, Dr. Msomi. I have a few questions here. The first one is why did you choose the real exchange rate against the dollar only, instead of choosing maybe the real effective exchange rate where you compare it with a basket of currencies for countries that are trading with South Africa? That's my first question. My second question is, you argued that this threshold was chosen arbitrarily earlier. But looking at your time period, I still believe also the threshold that you got depends on the time period you decided to choose. And you also arbitrarily decided to choose from, is it 2000 to 2021? Someone could have chosen 2010 further, but the graph that you have shown us, it seems there is data also from 1980. So what do you think? This arbitrary choice of your time period does it not have any bearing on the threshold? I believe it has. And then you'll have to justify then, which means now this threshold that we determined, if you can choose a different time period, we'll get another different value. And when you look at this time period, 1980 up to 2020, the graph you showed us, exchange rate has been appreciating consistently. But did we ever have any exchange rate crisis in South Africa? Because it's not just from 2021, 2001 up to now. When you look where it was in 1980 and the rate at which it has depreciated, we could have had any crisis, but did we have any? So is it a problem now that we are above that threshold? Then the last one is similar to what the other comment Kate has mentioned on the issue that it seems there are some fundamentals that are driving this persistence increase in inflation beyond just saying it depends on itself. There may be those factors beyond beyond the ones that can cause short-term fluctuations. There are these factors that can cause this increase in demand. And also exchange rate, unfortunately, depends even on the dynamics of the other economy. If this is the US, you are comparing, it's an exchange rate for rand and US dollar, then it means it also depends on what is happening in the US economy. So then sometimes South Africa might not have a problem, but developments might be occurring on the other economy. How are you taking that into consideration? Thank you.
Yes, Dr. Maketa?
Okay, thank you so much, Chair. I think mine is just to echo on what the previous speakers have already discussed. I have the similar issue of understanding the exchange rate regime because during the presentation, there's been a mention that if we see the exchange rate hovering above a certain threshold, appreciation, below certain threshold is depreciation. So I wanted to actually get the definition of exchange rate regime, because I think from my understanding of exchange rate regime, you're talking about different regimes, like whether we are on the fixed exchange rate regime, floating exchange rate regime, or managed floating exchange rate regime. So maybe there's been a mix of, unless if it can be clarified. Also, on the factors, on the determinants of exchange rate, I think according to the presentation, it looks like the lagged values of the exchange rate influence the current exchange rate only as the determining factor. But we know that whenever we talk about exchange rate, we are talking about an open economy. So it means that once you talk about an open economy, you're talking about the issues of international trade. So there's been no mention on I didn't get how the issues of export and import actually influence the exchange rate of South Africa. And also, like what Dr. Tamai mentioned, why do you use only the US dollar? Because I think your decision to determine which currency you're comparing with, like Dr. Tamai is saying, you should be looking at the effective exchange rate. also in that basket of effective exchange rate, you should look in particular the currencies of which South Africa is mainly, the currencies of the countries of which South Africa is mainly trading with. And the last question I want to make here is on the assumptions that I made about the economy of South Africa. Is the presenter assuming that South Africa is a large economy or a small economy, such that it can influence the exchange movement of the South African currency, can actually influence currency crisis only in South Africa or also outside South African economy? Thank you, Chair. Those are my few comments.
Thank you. Thank you all for your comments and contributions. Dr. Simiso, can you please respond before we take the next round of questions?
Okay. I'm sorry if I will not, if I missed some of the things that were said. Okay, thanks for the question. So firstly, in equation 2, so we estimate the exchange, the threshold autoregressive model as a delayed lag. So the model that we estimate, it's this model. But what I was defining here is that you also have a delayed lag whereby you specify by how much do you want the exchange rates, the response to be delayed in your estimation. So the delay can be calibrated in terms of how you think the response of the exchange rates is. Most people would take that from what is available in the literature or from what they believe in. Then the trim, when I spoke about the trim, the reason is the more you have more observations in use to define a variable, it means you have a better sight of explaining that, because you are defining the behavior from a larger amount of observation than using a fewer observations. So that is where the trim is coming from. That's why I spoke about it. Then now, the other questions were about was about the Sims critique. You see, the study does not attempt to explain what drives the behavior of the exchange rates. We don't care about that. The objective is to estimate the threshold of the exchange rate. We see how the exchange rate behave, then we use the exchange rate to see where would you say this is the threshold whereby it is deviating from its equilibrium. The easiest model, what people would say, they would take the exchange rate, then they would test for unit roots. They would say, this is the long run equilibrium. So it's one of the ways they can do it. So you in that case, there's no interest in what other variables are doing to contribute into the behavior of the exchange rate, but the interest in that case is where the equilibrium is, not how the other variables are influencing in equilibrium. Then, okay, sorry. Then the other question, I think the colleague asked, why not the effective exchange rate? So when you use the effective exchange rates, normally you would be using effective exchange rate to compare. Usually people, they'll use it when they're talking about the studies that are concerned with trade, the current account balance, and if they want to see how the rand behaves in relation to its trading partners. So that is good, and it's also explained the behavior of exchange rates in relation to the 20 trading partners for the case of South Africa. But now, most of the trade in South Africa takes place in US dollars. If you look at which currency when we want to trade, even when you want to buy goods that are, when we buy goods that are in the international markets that are traded by other countries, in most cases, they would accept those goods in terms of the USD, which means the USD is one of the most important currencies because it is a reserve currency. And if you were to go to other countries or central banks, when you ask them of their reserves, they will count their reserves in terms of US dollars. Even if you are buying from a country in Asia, they would be readily willing to accept your goods in terms of USDs than in terms of their own currency, because that is what is used to quantify, or it's one of the most stable currencies that are readily accepted for trade or international trade in the world. No matter what we say, the United States, the USD is the most important currency in terms of international trade or driving trade in the world as it stands, since we may say since the 1940s, and that has not changed, and it is not likely that it is going to change. So that is the reason why I used a bilateral exchange rate, which is the USD and the rand. So I was not interested on how the South Africa relates to other to other 20 trading or the 20 largest trading partners, but what I was interested in is how South Africa how the rand relates to the USD, because it's a big economy, and when we trade the commodities in South Africa, we sell them in United States dollars. So we don't trade in rand. So it's one of the most important currencies for international trade. Then the period is not arbitrary. Because I start. So if you look at the monetary policy framework of South Africa, there are different periods. So you have a period from 1960 to 1968. That's when the South Africa left the pound sterling and used the rand. And then during that period, South Africa was pegged to the United States dollar. But then from the 1960s, then the South Africa started implementing dual exchange rate system, which means it's a different monetary policy regime. Then if you go until then you go from that period until 1970s. Then now I can go on and go on until 1995, where we started using the single exchange rate method, or we did away with the dual exchange rate system. Then from 95 until until year 2000, South Africa was targeting money growth, or was targeting the exchange rates and during that period. So it would come back and advise what the exchange rates should be, or what was the target during maybe that month or that week. Then from year 2000, South Africa started implementing inflation targeting, which means it's a different monetary policy regime, and the exchange rate in year 2000 started fluctuating. So which means it becomes an interesting period to study any macro or any monetary policy event in South Africa from that period. However, maybe the confusion is I showed a long swing of exchange rates. The reason was I was trying to show that the picture, when you look at the exchange rates from a prolonged period, it's very concerning. But the study starts from year 2000, because it is influenced by that by the reasoning that from that period the exchange rate started. The South African Reserve Bank started inflation targeting as its policy that it was pursuing. Then I think the definition, so in terms of the regimes, so now we are not defining whether it's fluctuating or not fluctuating. So take that away. So that is what we do in class, and it is good. But when we talk about regimes, in this case, in this study, the regime is whether the exchange rate is in it's appreciating or it's depreciating. When it is, or we are defining it in terms of whether the exchange rate is in a crisis regime or it is in a stable regime. So in that case, we are not trying to define whether it is fluctuating or not fluctuating. So that is not an interest of the study, but we want to see where is this the exchange rate headed, or where, in which position it sits within during this particular period. Okay, I think I've covered why the USD and the influence of the if I've missed something, then the colleagues would have to email me, and I'm happy to discuss the paper offline if I've missed something. I'm sorry. I think I've tried to recall everything that I've noted down here. Over to you, Chair.
Thank you very much, Dr. Simiso, for responding to those comments. We are starting another round of questions. I think I'll start this round. So my concerns, and I see Dr. Ntokozo again, so after me. So I have a couple of concerns, which some of them have been highlighted in other ways. But the first one is on the issue of threshold. Except I stand corrected. My understanding for thresholds would be this point beyond which the exchange rate, maybe if it's in a positive trend, can no longer go, it comes down, or below which it doesn't, basically that point which it curves, which it changes direction, a cap of some sort. So if that is valid, then
Sorry, Chair, can you repeat? There's a part I missed. I'm sorry.
Okay, so I was saying that my understanding of threshold is that there is a point beyond which this exchange rate, the trend is not supposed to go, or below which it's not supposed to go. And like you've explained by several studies that you've reviewed, Hoffman 2007 says all exchange rates follow different behaviors. And more importantly, the Pratt-Sech et al. 2015 that says the behavior of exchange rate is inconsistent with any structural relationship. So when you now say a threshold, in some sense, you're saying there is a structural relationship, if according to my understanding, I stand corrected. So and we know that exchange rates, the spikes we see in exchange rates are largely driven by shocks. So if you're putting up a threshold and you're putting up a policy recommendation to say we should always watch out for this threshold, and that threshold was determined initially by an economic shock or an external shock, is it not misplacing that definition of threshold? Because now you're simply saying, watch out for this threshold because this is where we had this structural break and this spike. Meanwhile, that spike was created by, let's say, COVID-19 that we may not experience again. So how do you, in your analysis of the threshold, isolate the impact of external shocks? That would be the first question. The second question is, on the topic, looking at the topic, for me, the one that was sent earlier on the seminar, for me, is more representative of the study, or a bit better, and I'll explain why. Because in what you present today, we see determinants of the threshold. That presupposes that there is a threshold. So, and if there's no threshold, then you see, you've taken out the juice of the problem statements from it. So that's curiosity of whether there's a threshold or not, and then you find it, and then it is whatever it is, then that should be the study. But once you say determinants of threshold, already you're saying there is a threshold. And according to my earlier understanding of the threshold, that also may be an issue. The third one is on the crisis. You know, there's this value you had, and you said if exchange rates go beyond that, then it means we are in a regime crisis. And this point is linked to the Sims critique. So can we honestly say that a macroeconomy will be in a crisis only determined by exchange rates? And even if it's determined by exchange rate, is it not subject to the level of foreign reserves, the level of money supply, the level of inflation, the level of GDP, and so on and so forth. So I think exchange rate on its own, if we are in, yes, I understand that your study is just looking at the threshold, but now I'm looking at your interpretations, your inferences from that study. So if you're to recommend that this is where we should, the crisis period starts, and that interpretation is only based on exchange rate alone, then what much more, what happens to how it relates with foreign reserves and so on and so forth. So that again is something you need to consider. The fourth one is the issue of the 15% and the 5%, which was highlighted earlier by Ntokozo, which you missed out when you were responding. Was it arbitrary? How was it chosen? Finally, which is this one now is an offshoot from the argument of the real effective exchange rate. The exchange rates is largely driven by trade, right? And trade, like you have explained, is in South Africa, is mainly done in the USD. But it's not the only currency, and it's not the only way to drive exchange rates. The foreign reserve, the foreign exchange markets, they trade in all currencies. The black markets of exchange rates, they trade in all currencies. Just the exchange of currencies that happens at the level of airports and all gateways to the international space also has a lot to do with how it affects the exchange rates. So I think you could still consider the real effective exchange rate, because in considering the real effective exchange rates, you will not be losing out on getting the USD. If the USD indeed, by and large, determines the market, then you will still get that in the real effective exchange rate. So you'll be able to capture whatever you would miss if you had gone only with the USD. So those are my comments. So I can give the floor to Ntokozo, and then maybe we'll seek for a third hand.
Okay.
You have the floor.
Sorry,
Ntokozo.
Chair. I wanted, because you gave a number, I wanted to. Okay, no, Ntokozo can go on. It's just that I think I was going to forget, but it's okay. Ntokozo can go on.
Thank you, Chair.
Oh, okay. Ntokozo, if you permit, so that he doesn't miss out.
All right.
If yes, let him address them now.
Okay. Thank you for the comments, and I'm going to look into them. And I think they make sense. And in terms of I think some are subject to a scholarly determination. For example, I don't think that the South African rand is driven by trade. Yes, there is literature that says that, but I don't think that is what drives the behavior of the rand. For number one, if that was true, it means the case that is in court in South Africa about the manipulation of the rand wouldn't be in court, because the rand there was manipulated without trade. They were just shifting resources, they were just shifting money within the banks, and they were able to cause a huge shift in different periods in time for more than 7 years. They were able to do that without having any trade. And there is a book which was published in year 2001 by Lyons. So he writes about the microstructure of exchange rates. And so you can also see the paper by Msomi and Galao, 2024. So we also explain how the exchange rate moves. In that paper, we say that amongst many things that are available there, we also quote that at the end, there are unobserved factors that shift the exchange rate, and they put so much pressure, which causes the exchange rates to end up moving in a direction that is not intended. Then let me go back to this book by Lyons. So when he explains, he says that if you go to any traders in those multinational corporations, the way they trade billions whereby when they trade a currency, it is not dependent on fundamentals. So in chapter 1, when you get time, you must read just an overview of the book. Then, so the guy, he explains what he saw when he went on to collect data at a New York Stock Exchange. So what is seen in practice is not what we do in class. The fundamentals do not determine how the traders trade currency in the foreign exchange markets, and large amounts of the currency also moves in the foreign exchange markets. And if the case was, for example, the reason I'm saying I don't believe that the trade is the major contributor, when there's a huge when there's a higher amount of, for example, right now, gold is trading at the highest price it has ever traded in over 100 years. But that has not impacted on the exchange, on the rand exchange rates against all major currencies, because if you read, I think it's Frankel 2007 who says that the commodities drive the rand, but then why don't we see an association or correlation of the rand being appreciating against the USD, so, or major currencies? So that's why I'm saying it's something that is subject to scholarly determination, but it cannot be accepted as true. Maybe in South Africa, the relationship between the rand and other exchange and other currencies is different from what is seen in the literature in the literature, what other people might say or what we teach in class. And I wanted to come to this. I think you made a good point, and I did not think of it, whereby you indicated the threshold. So when we did this, this is what we had thought. So as normally, when you see any study that estimates the equilibrium of, or most common studies that we've seen in the past, whereby they estimates the equilibrium of the exchange rates. So they would roughly take the exchange rates and, as I said, and just do the unit roots to show that it might have unit roots at level, but when you difference it once, therefore it is stable, which means in the long run it goes back to equilibrium. But in this, that is what they consider as equilibrium. But what we did here in this study, we said, okay, you have that background whereby people have done that. Now, you have this constant depreciation of the exchange rate. So when it goes up, as you see, so we use the so when it increases, as you see this shape, this shape, when it goes up like this, it means it is depreciating. But when it falls down, therefore it's appreciating in that sense. So this, when it goes up, it doesn't mean that it is appreciating. So, or let me go to show this one. So this is a depreciation, but when you see it go down, then it's appreciating. So now, starting from there, so what we wanted to see, because if you difference this, you get equilibrium, then what would you consider from that background as a normal deviation from equilibrium, from something that has appeared in the literature, whereby people say that is equilibrium? That's where the study hinges on, or use as the reference point. Now, so we have no interest of getting of seeing what other factors influence the behavior of the exchange rate. So we did not want to do that. So what we wanted to see is if you look at the variable exchange rate itself and you think it is at equilibrium, then with everything that influences it, how is it behaving? We don't deny that there are so many factors. Some we do observe, some we don't observe. But whenever they've had an effect on the exchange rates, and from when you have, where can you say we draw the threshold when we say if it continues at this pace, therefore it is headed to it is headed to a depreciation. Let me move on to another point. I know I sense that I might not be making sense. So with the 15% of the trim, so if you estimate right now, I did try to highlight that you find this from the literature, or it is based on how you want to estimate the variable. For example, if you program it, therefore you'll have to specify the trim. But if you go on, you estimate whereby you don't program it yourself, usually it would choose 3%, 5%. Then now, in my understanding is that when you have more variables, when you have more observations, so it allows you to explain the behavior better. So that's why I increased the observations I'm going to use to explain the behavior, or to explain the threshold. And okay, let me come back to other questions, because I sense that I'm taking long explaining. Maybe Ntokozo might want to maybe say something, but I will come back if I recall other points that you've made.
Thank
Thanks.
you. Thank you. Ntokozo, please.
Thanks, Smith. So that was a very long discussion. Sounded like a presentation itself. Anyway, just a follow-up question on the issue of equilibrium. Maybe you don't necessarily need to respond. You can just reflect in your own time. But now I agree with the colleagues to say that maybe you could have used the effective exchange rate, because equilibrium is not just determined by one force. And I think you keep on mentioning a paper by Msomi and Ngalawa, and the point that you are mentioning there is very crucial. You're saying that exchange rates behavior is driven by some hidden factors. So now this tells me that exchange rate is not just a function of itself, of its positive values, meaning that the equilibrium, remember the construction of equilibrium, it means that is where different forces balance. So now, if you are saying that, that means the equilibrium of the exchange rate will also be influenced, even the threshold that you are trying to estimate will be influenced by other factors. So now, what I was expecting to see based on your explanation is that those hidden factors will be part of your equation. How you model those hidden factors, it should be relatively simple. You take all the fundamentals. You then use the, you can use any dynamic factor models to extract the hidden unexplained factors. Then you use that idiosyncratic factors as one of the determinants of your equilibrium. Because I certainly don't believe that you can estimate an equilibrium by just regressing exchange rates on itself. And also the baskets of goods, I think you'll get even a good picture by considering the baskets of all currencies, the effective exchange, rather than focusing on the US dollar. And I disagree to say that, yes, we may be trading with US dollar, but if you check from the SARS they will tell you that the dynamics of trade have changed. I think the colleagues that they are not saying that exchange rates are solely determined by trade, but they are emphasizing that trade plays an important role. So meaning that that's one factor that you cannot left out when you are talking about exchange rates. Of course, there would be many other factors which is why I believe that it will be good if you take all those other many factors that you deem based on the literature important for the determination of exchange rate, then you extract that common component from them, which you will then use in the estimation of your exchange rate behavior. And also the question of the trim, we are not disputing the fact that if you have more sample, that will improve the accuracy of your estimates. That's not what we are disputing. But the question is, if even you're saying that the default is usually 3% or 5%, but that 5% is based on some scientific reason. And here you are extending it from 5 to 3%, I mean to 15%, but we are not providing that scientific reason why, besides the fact that you are just increasing the sample size. But you could have chosen 25%, you could have chosen 50%, you could have chosen 100%. What informs the 15% that you are choosing? And also you're saying that in the motivation of your study, you said that the definition of threshold is random in the literature. But I don't see how is this, your definition, not random, how it differs from the previous literature. 1.9, I can estimate 1.8. How is it not random? You're not providing the justification, a scientific justification for, so to say, you are not motivating, you are not discussing anything beyond, besides just saying that no other studies are using a random definition. OJ can estimate his own, that will be random. As long as I'm sure you get what I'm trying to say, but you don't have to respond to these points. These are just points that you can reflect and see how you can improve your project going forward. Thank you, Chair.
Thank you very much. Our time is fast spent. Is there any other pressing comments or question before we close this round and give the floor to Dr. Simiso to respond? If there is none, Tokozo, that should be an old hand. If there is none, Dr. Simiso, can you respond and maybe conclude so that we close?
Okay, thank you,
for the day?
colleagues. I think largely Ntokozo's comments were more of something that I have to look into, which might need some justification or a stronger justification. I'll look into it. What is the scientific reason of choosing 3 or 5? Well, in a way that I looked at it, and in a way that I've been observing how other people estimate the threshold autoregressive. The idea is you prevent the model from choosing from choosing a threshold where there are lower observations. So that is how I saw it, or that is how I've seen it in other studies. Yes, there's none which is so there are only 2 studies that I've seen where they estimate the threshold using the TAR model, which is this one and the previous one that I've spoken about, which I am citing. Which I have to look into it, but I doubt that the reason would be in the estimation of the threshold. So with the other comment of how it's being arbitrary, so we are estimating it in the study. We are estimating the threshold value whereby we say once the exchange rate keeps depreciating above this point, it is headed to a crisis mode. So it is, I believe in that sense, it is scientific because we have done so much work. We collected the data, then we estimate and we see what the model gives us or what the variables are giving us. Instead of just defining it and saying if this process happens, therefore there is a crisis. However, all the comments are valuable and it's something that I have to look into. If I miss something, I wish colleagues you will not be so far away that I can contact you maybe to give me that insight so that we can improve this work. Maybe it will produce something even greater than what I initially had in mind.
Thank you. Thank you very much for those very pleasing concluding remarks. We are also very happy that oh, Dr. Johnson.
Okay, thank you so much, through you, Chair. And I want to just add a little voice to what Simiso have just said. That has been a very good time together, especially the interaction, the questions, and the suggestions that have been made. That most of these are noted, and the other aspect of it is that I want to say is that the issue of the different forces that actually balances the equilibrium, what you call equilibrium, which actually gives a reason for considering the real exchange rate as suggested, is noted, and that to be seriously looked into. Use that issue of using real effective exchange rate, and as well as reshaping the title of the work, as well as considering the issue of justification. Though, as Simiso said, that what I had in mind in the justification for that issue of threshold is that when there is a depreciation, when it's to a point, and then it starts actually to change direction or move into another episode, at that point is what we take to be a threshold. But nevertheless, we find further scientific justification from this other study that have been done in Australia and others. So I want to say that it has been a very nice time, and the contributions has been very useful. And then it has also given more insight to other aspects to be looked at, and really appreciate the contribution of everyone that has participated. Thank you.
Thank you very much to the authors. I should also draw your attention to the charts. There's two comments. One is that you could consider, if you don't want to go with it all together, you can consider it as a robustness check, and it will actually be enforcing your thoughts on how exchange rates in South Africa plays out of the rand. Secondly, you're advised to share your email so that the recording of today's session can be sent to you, so that you don't miss out on any of the comments if you so desire. On this note, I would like to thank all the participants for coming. I would like to thank you very much for your presentation, Dr. Simiso, and for the paper, Dr. Adelakun. We thank all those who made comments and those who were here to listen. I am sure that we all learned. We are always happy to have presentations made in our seminars, in our departmental seminars, and we are usually even more happy when we get external participants like yourself, Dr. Simiso. So we are very delighted that you chose to present this paper with us. We hope that we have contributed in our own small way to advancing the good scholarly work that you are doing. So on this note, I would like to close today's seminar until we meet again. Thank you very much.
Thank you. Bye.
Thank you.